Folks, we've recently seen the S&P 500 hit record highs amid stronger than expected corporate earnings. I'm getting lots and lots of questions from you about earnings. Today, we're looking at a key driver of earnings prices, earnings per share. It's generally considered to be the single most important variable in determining a share's price. But what does it mean for your portfolio and your trades? How is it useful to you as a trader? Let's take a look in today's session. First off, if you also follow my friend and colleague Rob Booker, do not ask him this earnings question because, well, you're going to get an earful. Still curious? Click the button below and see what happened when Rob and I discussed this. It's definitely causing some shockwaves for traders all over the world. Watch it at your own risk or gain. All right, let's talk about earnings per share. It's really important depending on what you're trying to accomplish. First of all, what is earnings per share? Well, stocks make money. They report this money, what they make or what they lose or what their cash flow is on a quarterly basis. It happens 4 times per year, all right? Every quarter. It happens every 3 months. So, exactly what are we talking about here? What's the big deal? Why is it so important? Let me explain to you the process. Analysts look at stocks, they look at their bank sheets, they look at their bank statements, they look at their profits, they look at their losses, and they come up with expectations based on actual reported earnings. And they come up with a consensus based on what they see and what they believe the future will hold, the next quarter will be. And the stock's price will automatically move to price in the numbers, the earnings that these analysts believe the price of the stock will reflect. Now, here's the cool part. It doesn't really matter what the actual number will be. What matters is the difference between the actual number and the expectation, because the price of the stock will always reflect at the time earnings come out what's reflected by the analysts. So it's really important because here's the thing. You can have a stock that's always underperforming, but the expectations are much higher. So the stock is always reaching for, it's always doing better than expected, but underperforming, but price will still rise. And we've seen that happen many times. The price or the earnings disappoint, but not based on the expectations, because the expectations could be higher or they could be lower than what's going to be actually coming out. So don't really focus on what the actual number is. Focus on what the expectations are and the difference between the actual number and the expected number. Another major important factor of earnings per share. When earnings per share are higher and higher every quarter, it attracts institutional attention. Institutional attention means consistent accumulation of shares via hedge funds. And when hedge funds buy, they don't buy 1 million shares at once. They do a little bit every couple of days. And what happens is the stock's price begins trading higher and higher based on slow but consistent accumulation. So earnings per share are really important because, one, they drive analysts' expectations, B, they drive actual price, and 3, they drive expectations for future price movement. So EPS is really important, and it's one of the biggest factors that I look, and it's one of the key factors that are programmed into many of my systems that are not being driven purely by momentum. So again, earnings per share, really important because it tells us where the price of the stock should be in comparison to the analyst's estimates. And it also gives us a target. Granted, it's a moving target, but it gives us a target for what the stock is doing each quarter. Hope that helps. Again, if you're swing trading or day trading, and if your holding period is like 2-3 days, earnings per share is not going to help you. But if you're holding stocks for, say, a month to 2 months, and you're buying on pullbacks and you're looking at the main trend, the earnings per share will 90% of the time coincide with the main trend of the market. So for example, if earnings per share trend is positive, you'll see the stock trade above the 200-day and the 50-day moving average. If you see the EPS earnings per share become negative, or weaker than expected, then you'll see the stock continuously trade below the 200-day and possibly below the 50-day moving average as well. So the earnings per share will give the stock its underlying direction or trend. Maybe not immediately, but over time. Hope that helps and answers the question about why earnings per shares are so important. So, when do stocks go up? Typically earnings season. It happens 4 times a year. But what's the best way to make money when stocks go down? Click the button below this video and I'll show you right now. It doesn't matter what the stock market does. This is the strategy that you always want in your corner. And I bet it's not what you expect. What is it? Click below to find out now. Because after the market makes highs, something's got to give. And you need to be ready for the drop. Tap below to learn how to protect your portfolio and profit in any market environment. Don't wait for the plunge. Do this right now.